Hey guys, my name is Junior and welcome back to this Basil FX trading channel. In this episode, I'm going to be explaining to you the basics of candlesticks. I'm going to be giving you a full explanation on how to trade candlesticks and what story is behind candlesticks. As you can see, the green bars and the green candlesticks, those green things and the red things that you're seeing, those are called candlesticks. As all you know, all of you guys, you know that candlesticks follow under the candlestick charts. We have three types of charts. We have the bar chart, we have the line chart, and the candlestick chart. So in this episode, the most traded one is the candlestick chart. That's the one I'm going to be explaining today. Each of these candles that you see, they have an explanation and they have a story behind them. So without further ado, subscribe to this channel and let's get started. So basically, now this is a naked chart, and by the word naked chart I mean there are no indicators. There's nothing like technical analysis on this chart. So to be able to play it like the pro, or to be able to read charts like the pros, you need to know about these candlesticks. You need to know the story behind each of these candles that you see here. Each of these small, the bigger candles, they all have stories they tell. So in this video, I'm going to be giving you a full explanation on each of those candles. What do they mean and what stories do they all carry? So follow me around, watch this video from the start to the end, and don't miss out on any part of it, because I'll be explaining full details on these candles. What is a candlestick? So basically, candlesticks are formed using open, high, low, and close of a chosen time frame. So these are candles. The green one represents the bulls or the bullish, and the red one represents the bears or the bearish. So for a bullish candle to form, it opens from down, as you can see, then closes from up, as you can see. Then the bearish candle opens from up and closes from down. So you should know this. Whenever a market is going up, you have green candles, and all those green candles, they open from down and close from up. Then if you have a market going down, expect to have red candles on that market. So the red candles open from up and close from down. And these candles, you can name them any color that you want, but these are like the default colors that are used in the forex market. So green means bullish and red means bearish. And you know, as you all know, bullish means market is going up, and then bearish, it means the market is coming down. So all these candles have highs and lows. As you can see, for the bullish, the low is the same as the bearish low, and the highs are all the same. And all these candlesticks, they represent a certain time frame. So if you are on a daily time frame, each of these candles would represent a daily. They will be representing daily candles. So let's say 1 hour here, you see. So each of these candles is 1 hour. If you're on a monthly time frame, each of these candles would be representing 1 month. So this as you can see, this is 1 hour. So all these candles are 1 hour, 1 hour. So let's move on to the candlestick body sizes. As I showed you in the naked chart, you saw the small candles and the big candles. So as you can see, you have the big candles, the bull green big, and then the red candle that is big, and then the small one. So basically, the green bull candle that has a very big body, this is the body. You see that body is very big, so it represents much buying pressure for the green candles. Then this red one, it represents much selling pressure in the market. So meaning, on this green one, the buyers are aggressive, and here the sellers are aggressive. So meaning, when you find these candles on the market, on your current market, just know that if it's either the green candle, it means the buyers are aggressive, and if it's this red one, it means the sellers are aggressive. Then when you find these small candles, it represents less selling pressure. So like this red one, it represents less selling pressure, and this green one represents less buying pressure. So meaning, when you find these candles on the chart, you can know that sellers are less now. There's less selling pressure, meaning buyers are coming out anytime. But if you find this green one on your chart, then you can know that the buying pressure is less. It's not too much like this big one. So basically, these big candles, they represent aggressive selling or aggressive buying. Then this small one just show us that there is little selling or there is little buying. So let's move on to these candles that have long shadows. By shadows I mean wicks. These sticks here, those are wicks. As you can see where the arrow is pointed, long upper shadow, that's a wick, or you can call it a shadow. So when you find if a candlestick has a long upper shadow, this red one, this is the one I'm talking about right now. So if a candlestick has a long upper shadow and a short lower shadow, this means that the buyers flexed their muscles and bidded price higher, but for some reason sellers came in and drove the price down. As you can see, it means the buyers tried bidding the price up here, but for some reason the sellers came in and drove the market from up here to down here, and then closing that market session or that current candle in a red candle. So meaning anytime soon when you find this candlestick on your chart, sellers are coming in anytime. As you can see that they tried flexing and took back the market down. So meaning even these other candles, sellers may come in anytime. But if you find a candlestick that has a long lower shadow and a short upper shadow, as you can see this green one, this is what I'm talking about right now. So this means that sellers tried bidding the price lower, so tried taking the market down, but for some reason the buyers came in and drove the markets back up to close that market session, to close the current market in a green candle. So meaning if you find this candle, and most times we find these candles, the green one, the one that has a long lower shadow, we find it on a downtrend. So we find this red one on an uptrend, and we find this one that has a long lower shadow on a downtrend. So meaning when you find this one in a downtrend, you know that buyers anytime soon are coming in. So this is what. So let's move on to the spinning tops. So this is a pattern, a candle pattern. So candlesticks with long upper shadow and long lower shadow. As you can see, this is a upper shadow and lower shadow. So candlesticks that have long upper shadows and long lower shadow and small real bodies. These are the small bodies. Those green one and the red one, those are the bodies. They are called spinning tops. So the color, these colors don't really matter. They're not very important. It's just that this pattern indicates that there is indecision between buyers and sellers. By that I mean the buyers and sellers are undecisive. They're not deciding either to let the market be all buying or be all selling. So basically, this pattern, when you find these candles in the market, just know there is indecision in the market. So I'll start with this one. When you find this candle, this spinning top green candle, basically it means that when you find it on a chart, it means there are less buyers left in the market. There are less buyers left in the market. So meaning sellers are going to come in anytime. So, but if it's this red one, it means that there are less selling sellers, or there is less selling pressure in the market. So buyers are going to come in anytime. Let me hope that that's a very clear explanation for this pattern. This pattern, it just represents indecision. They're undecisive. They're not deciding if the market is either going to be bullish or bearish. So just know when you find this, it just represents that there is less buyers left in the market and sellers will come in time. But if you find this spinning top, the bearish spinning top, it represents that there are less sellers left in the market. So meaning the bullish candles are coming in anytime, or there are buyers coming in anytime. That's what simply the spinning tops means. So let's move on. So let's move on to the Marubozu candlestick pattern. This is one of the most important candlestick patterns we have in the forex market. So this is a Marubozu. And by the word Marubozu, we mean Marubozu means the bodies have no shadows, or there are no shadows coming from the bodies. As you can see, there are no shadows coming out. It's totally just the body. So meaning the highs and lows of all these candles are equal to the opens and high and the closes of both candles. So Marubozu candle, we have the bullish Marubozu and the bearish Marubozu. So a bullish Marubozu contains a long green candle with no shadows. As you can see, this one, it has no shadows. So this is a very bullish candle that contains, this is a very important bullish candle that contains a very big body that shows that the buyers were in control of the whole entire session. As you can see, it just shows the buyers are aggressive, the buyers are in control of the market session. And usually this is the first part of the bullish continuation. So this is the candle that we receive when there is a bullish continuation in the market, or there is a bullish reversal pattern. This is the candle that we always receive. It should just, when you find this on your market, just know that there is a continuation, there is a bullish continuation that is going on that market. But if it's this red one, it just shows us that the sellers are in total control. The sellers are in control of the entire market. And we receive this when there is a bearish, or there's a selling continuation going on. This is the candle we receive. Or when there is a bearish reversal, this is the candle that we receive. So basically, this explanation is just the opposite of this one. If the buyers are in control here with the big green candle, the sellers are in control of this market. That's what basically the Marubozu candlestick means. So let's move on to the bearish engulfing candle. This is called a bearish engulfing candle. So this bearish engulfing candle, this one you see, is one of the most important candlestick patterns that we have in the forex market. So this candlestick, it consists of two bodies. The first body is a smaller one than the second one, or in other words, the second one engulfs the previous one, as you can see here. So as you can see, so this candlestick pattern, it gives us valuable information about the bulls and the bears in the market. It tells us a story, like it has a story that is telling. So in case a bearish engulfing bar, the pattern tells us that sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that the buyers are engulfed by the sellers, which signals a trend reversal in the market, as you can see here. So when you find this pattern, which is called the bearish engulfing candle pattern, it just indicates that the sellers are coming in, and it just indicates a reversal. When it happens on an uptrend, it just indicates that there is a trend reversal. So if it has been the bullish engulfing pattern, or the bullish engulfing pattern, the bullish engulfing candle. So this is another pattern that is very important. It's just the opposite of the bearish engulfing candle. So this pattern involves a small bearish candle and a big bullish candle, which represents that it just represents that the bull candle is engulfing the red candle. So basically, with this candle pattern, it happens on a downtrend. As you can see, market must have been coming down for a long time. Not for a long time, it depends on the time frame that you're on. Then when this pattern appears, it just shows that the sellers are now weak and the buyers are taking control of the market. So it represents a trend reversal, meaning if the market has been coming down in a downtrend, so market is going to reverse and go back up by just after seeing that trend, the pattern, which is called a bullish engulfing candle. So as I've told you, we have the bearish engulfing candle and the bullish engulfing candle. So the bullish engulfing candle mostly shows reverse on the market, and some to the bearish, it shows also reverse on the market. So let's move on to the Doji candlestick pattern. So the Doji is one of the most important Japanese candlestick patterns. When this candlestick forms, it tells us that the market opens and closes at the same price, which means that there is equality and indecision between buyers and sellers. There is no one in control of the market. As you see here, this is the candle. It's called a Doji candle. So when this candle forms, it also represents that it represents indecision between the buyers and sellers, or it represents no one's in control of the market. So when this Doji forms, it means if the market has been going up, as you can see, it means the buyers are not deciding either to still go on. So the market, there will be a trade reversal. So if this has been an uptrend, it will go. Then this candlestick appears, which is called a Doji. Then there will be a reversal to the downtrend. So market will be coming down after the formation of that candle. And if that candle forms on a downtrend, so let's move on to the dragonfly Doji. This is another type of bullish candlestick. It's called a dragonfly Doji. So the dragonfly Doji is a bullish candlestick pattern which is formed when the high, open, and close are same or about the same price. As you can see there, the opening and the closing is just about the same price. price. So what characterizes the dragonfly doji is the long lower tail or a wick. As you can see, the long tail there, it's very long. That shows that the resistance of the buyers and their attempt to push the market up. So this long tail or the long wick, it just shows that there was an attempt by the buyers to push the market up. As you can see, the market went and closed from up, as you can see there. So this is called a dragonfly, and this dragonfly, it happens mostly on a downtrend, as you can see. So when it appears, basically it shows us that the sellers were in control, but after when this candlestick formed, the dragonfly doji, it means that now there are less sellers in control, and there is going to be a reversal in the market. So this doji candle mostly represents there is a bullish reversal. Then the market will start going up, as you can see. So there are less sellers in control because the buyers pushed the price back to the price to be equal to the open and close. So let's move on to the gravestone doji. So a gravestone doji is a bearish candlestick. So this is another type of also doji. So the gravestone doji is a bearish version of a dragonfly doji. It is formed when the open, as you can see here, the open and close are the same about this, and the close are the same or about the same price. So the opening and the closing price are all the same. So what differentiates the gravestone doji from the dragonfly doji is the long upper tail. So for the dragonfly, it has a long lower tail, while the gravestone doji has a long upper tail or a long wick. So the formation of the long upper tail is an indication that the market is testing a powerful supply or resistance area. As you can see this image here. So the image above illustrates a perfect gravestone doji. This pattern indicates that while the buyers were able to push the prices well above the open, later in the day sellers overwhelmed the market, pushing the price back down. This is interpreted as a sign that the bulls are losing their momentum and the market is ready for reversal, as you can see here. It's very easy explanation. As you can see this chart here, it just shows us that the buyers were trying to push the market up, but for some reason the sellers came in and they drove the market back down so that the closing price and opening price are equal. So meaning the buyers lost momentum and sellers came in strong. So this represents a reversal. So whenever you receive a gravestone doji, whenever you see this gravestone doji on your chart, just know there is a reversal in the market. There is going to be a bearish market coming up or a downtrend coming up. If the market has been in an uptrend, it's now going to reverse to the downtrend. So this is called a gravestone. So there are three types of dojis, as I've told you. The first is called the doji candle, which represents indecision in the market. Then the next one is called a dragonfly, which represents a bullish reversal. Then the other one is called a gravestone, which is this, that represents a bearish reversal in the market. Let's move on to the morning star. A morning star is also another pattern, and the morning star is considered as a bullish reversal pattern. It's also a very important candle pattern that you should take notice of. So the morning star pattern is considered as a bullish reversal pattern. It occurs at the bottom of a downtrend. This is what I mean, that it occurs at the bottom of a downtrend. This is where we find it, a morning star candle pattern. When we find it on the bottom of a downtrend, and it is formed of three candles. As you can see, this the red one, the big bearish, the small bearish, and the green bullish candle. So the first candle, which is the bearish candle, this one where I'm pointing right now, it represents, or it indicates that the sellers are still in control or still in charge of the market. Then the second candle, it represents that the sellers are in control of the market, but they don't push the market much lower, and this candle can be bullish or bearish. So this middle candle represents that the sellers are in control, but they don't push the market lower. That's why you see this, the candle is very small, it has a small body. And remember the first candlesticks that I talked about, candles that have small bodies represent less selling pressure. So meaning this candle, it's showing us that there is less selling pressure in the market. So meaning anytime soon buyers are coming in. So this third candle, it represents, the third candle is a bullish candlestick that gapped up on the open and closed above the midpoint of the body. So this bullish candle informs, it engulfs these two candles. Sometimes it doesn't engulf, sometimes it engulfs. So this is our bullish candle, but this candle, it's mostly the reversal. It's our reversal signal. This green candle that you see, when it forms, it holds a significant trade reversal signal. Yeah. So this is our morning star. So this is what I meant. So this is our downtrend. You see, market coming down, then it happens here, the morning star reversal candle. Yeah, the morning star, it happens. The first candle, as I told you, it forms, which shows that the sellers are in control, as you can see there. Then the second small green candle forms. But remember I told you this middle, the third candle, I mean the middle candle, it can either be bullish or bearish. So in this case, it's a bullish candle. And then our candle that holds a significant trade reversal forms. Then this is our pattern, a morning star. Then the market reverses. So this is also a trade reversal. It's a bullish trade reversal pattern. Let's move on to our next candle pattern, the evening star candlestick pattern. This is the opposite of the morning star. So this evening star candle pattern is considered as a bearish reversal pattern, and usually occurs at the top of an uptrend. As you can see, it usually occurs at the top of an uptrend. So this pattern consists of three candles. The first candle as a bullish candle. Then the second one this second one can either be bullish or bearish. So, and it can also either be a doji candle, it can be any other candle, this middle one. Then the third candle is a large bearish candle. In general, the evening star pattern is a bearish version of the morning star, as you can see in this picture, as you can see here. So the evening star candle, this first part of the evening star is a bullish candle, the first part, as you can see here. So this means that the bulls are still in control and pushing the market higher. But after some time, even the second candle still shows the market is in control of the bulls, but the buyers don't push the market higher. Then the red candle comes in that has a significant signal that there is a significant reversal signal that the bulls are now done. The bull run is done and the bears are coming in. So basically this evening star pattern represents a bearish reversal in the market. So that's what basically what it shows. So as I've told you, the first one was a morning star, which represents a bullish reversal. Then this evening star represents a bearish reversal in the market. And all you have to know that these candlesticks, where do I find them? That's the most important thing. You should know that the evening star, I find it on the top of an uptrend. Then the morning star, I find it at the bottom, the last part of. So our next candlestick is called a hammer. This is a hammer, this one. So the hammer is a candlestick pattern created when the open price, the closing price, and the high are roughly the same price. And it's simply characterized by the long lower shadow. So a hammer is characterized by a long lower shadow. So this hammer is a reversal candlestick pattern, and when it occurs, and it only occurs at the bottom of a downtrend, as you can see here. This is our hammer with its small body up there and a long lower shadow. So this candle forms when the sellers push the market lower after the open, but they get rejected by the buyers, so the market closes higher than the lower price, you can see here. So meaning the sellers were trying to push the market lower, but for some reason the buyers came in and they rejected, or the sellers were rejected by the buyers, and the market closes higher than the lower price. So definitely this hammer, it just represents a reversal. It's a reversal candlestick pattern, and it only occurs on a downtrend. As you can see, this is a downtrend. So meaning this kind of formed and the selling went on, but for some time then after there was a rejection from the buyers, then the market went and closed from up. This candle is called a hammer. So our next candle is called a shooting star or a bearish pin bar. This is it, a shooting star. So the formation of this shooting is formed when the open low and close are roughly the same price. So literally the explanation for the hammer is just the same as this one. It's just the opposite. So this candlestick is characterized by a smaller body, and a long upper shadow, or a long upper wick, as you can see. So this is a bearish version of a hammer, or you can say this is just the opposite of the hammer. But in simpler terms, this is the bearish version of a hammer. So this candlestick is also a reversal candle, or you can say it's a bearish reversal candle pattern. So the story behind here is that the buyers try to push the market higher. Like they try to push the market, as you can see here, the buyers try to push the market higher, but for some reason they got rejected by the selling pressure. So when this candlestick forms near a resistance level, it should be taken as a high probability setup that the sellers are coming in. So meaning this market was forming, to went up green, then when it formed, it showed that the buyers were trying to take the market higher, or they tried bidding the market up, but for some reason they got rejected by the seller, or the selling pressure was too much. Then the market was drove back down, as you can see. Then it closed as a shooting star, or a bearish pin bar, or a bearish hammer. Then market started coming back down. So basically the hammer, the bearish hammer, or the shooting star represents a bearish reversal in the market. So basically those are our two types of hammers. We have the hammer, then the bullish hammer, and then the bearish hammer. And as you know, the bullish hammer, which is this one, it represents a bullish reversal. So meaning, and we only find this one on a downtrend when the market is going to go up. Then this is our shooting star, which forms on an uptrend, and this one just shows us that the buyers were rejected by the seller, or the selling pressure was too much, and then there was a reversal in the market, and market started coming down. So guys, if you came this far, these are what I just took you through. Those are candlesticks, and those are the most important candlesticks that we have in the forex market. So all you have to do is download this video on your YouTube, have it and watch it multiple times for you to be able to understand this candlestick, what are candlesticks. So all you also have to take notice of where do we find all these candles. If it's a morning star, where do we find it? Do we find it on an uptrend or a downtrend? If it's a engulfing bar, if it's a bullish engulfing bar, if it's a bearish engulfing bar, where do we find them? So that's all you have to take notice of. Where do we find these candles? We don't just find these candles anywhere. So basically the first candles are showing us the body. If the big bodies show us the much buying pressure, much selling pressure, then the small bodies show us much selling, the small bodies show us less selling pressure and less buying pressure. So I hope you enjoyed this video, and just download it, and if you need to watch it multiple times, watch it, so that you'll be able to understand what candlesticks are. I hope your trading journey goes well, and subscribe to this channel. Don't forget to subscribe to this channel, because I'm going to be posting in my next video. I'm going to be giving you the technical analysis. If you came this far, now I guess you know how to trade candlesticks. You know the story behind candlesticks. And when, let's say, if you open your chart, a naked chart, without analysis, you can be able to trade candlesticks. So make sure to subscribe to this channel and turn on your notifications so that you don't miss out whenever I post a video. I'll be posting videos weekly. See you in my next video.